Doug is a senior fellow at the Brookings Institution, where he is a specialist in financial services, broadly written. And the reason that he is deemed to be ultimately credible is that he was an investment banker for 20 years? Yeah. 20 years or so, principally with J.P. Morgan. So we're delighted to have Doug lead this panel and take it on.
Thank you. That's the first time in a long time that I've heard investment banking as a source of credibility. So thank you very much for that. So our panel is going to focus on what would you actually do if you did prudential supervision? What would that mean? Pros and cons, that sort of thing. You don't particularly want to hear me talk, so I won't very much. What I'm going to do is just go through the panel, then we'll follow the same procedure as you have seen with the other ones. I'll ask them a few follow-on questions, and then we'll take questions from the audience. So I should thank BU and ICI for giving me the easiest job in the world as moderator. The one thing I will do is I'm going to hold everyone to 10 minutes. So I apologize, I will be rude, I will cut you off. So let us keep it to that. And the bios are all here in detail, so I won't take your time with that. And let's just start with Tom Vertanian from Deckard.
Thank you, Doug. Well, the prior panel is a terrific lead-in for us in terms of what they talked about. I remember making a speech back in 1981 when I was a regulator, arguing that that guaranteeing the right to fail protected the right to succeed. And we were in the middle of closing 1,000 thrift institutions, so that was pretty controversial at the time. But I really do believe that that's a critical question, because the less we allow institutions to fail, the less we allow them to succeed at the other end of the spectrum. So what I'm going to do is try to bring a practitioner's approach to what's going on here in terms of prudential regulation, or potentially. Because at the end of the day, what is this really about? What it's really about, in my view, is two things. Number one, whether asset managers are going to be regulated by the Federal Reserve Board. And having practiced before the Federal Reserve Board now for nearly 40 years, I know nobody aspires to that goal, at least not sanely. And second of all, it's to give the government more buttons to push to control the environment, because I know what's happened. When I was a regulator back in 1981, about 85% of consumer deposits and consumer funds were in banks. Well, now I don't even know if it's 50% that's in banks. And so therefore, the bank regulators don't really have control. And I think we saw in the last economic fiasco was that they realized they were pushing buttons that weren't connected to anything and didn't control the problem. And I think what this is about is giving them some buttons that really work. So let's talk about prudential regulation. I've got some slides I'm going to go through in 1 minute. I've only got 10 minutes to sort of give you the history of prudential regulation from my perspective, but I've been thinking about it and dealing with it for 40 years. Prudential regulation, in my view, is basically a three-tiered animal. Number one, it's meant to protect the FDIC. And that's a critical factor here that obviously doesn't exist in the asset management world. Number two, it's meant to avoid bank failures, which of course gets into the discussion we just had in the last panel about whether you want or are going to allow bank failures to occur. And number three, it's there to be so that regulators can say we did something when the worst goes wrong. And the worst will always go wrong, and there will always be another financial crisis. Let me give you some perspective on prudential regulation from, again, from a practitioner's point of view, having dealt now with the FSOC on 4 or 5 occasions in a designation process. First of all, I think the asset management industry has got to educate FSOC often, early, and as much as possible. I think you cannot underestimate the lack of expertise and the lack of sensitivity that FSOC generally across the board will have to what the asset management business is about and what it does. Education is fundamental. And it's just not education by the big guys, because if everybody says, well, they're shooting at the big guys, let them do it, that's the wrong answer. Because Every piece of prudential regulation that's ever been applied to a big bank eventually gets applied to a small bank. And it's called the trickle-down theory of regulation because it becomes a best practice once it's being done by the larger banks. So if you think you're a small asset manager and you're not going to be subject to this and you can stand by and let the fight occur, I think that's the wrong answer. Second of all, having now been through the designation process several times and having one client designated, it is extremely important, and I think this, I give great kudos to MetLife, it's extremely important for somebody to challenge this process. I think the process is flawed, and it's flawed in a number of different ways, and for students of the Administrative Procedure Act, I think the MetLife case will make an interesting case. Because there's a fundamental flaw in the process that we have argued to the FSOC and have yet to convince them, that you can't identify a company for systemic regulation unless you know what the Federal Reserve Board is going to do when it regulates them. Otherwise, it seems to me that is patently the definition of arbitrary and capricious activity. But we'll see if we get there in this litigation, which I think I will have a chance to participate in and test these theories a little bit. The last point I'll make before I go through these prudential issues very quickly is the fundamental issue here is we're talking about a threat. We're not talking about, as the FSB has just said on page 10 of its consultation released last week, we're not talking about the probability of that threat. We're talking about the impact of that threat. So are we underwriting for a 100-year flood or a 200-year flood or a 500-year flood? Arguably, we're underwriting a 1,000-year flood if probability doesn't matter. And the FSOC's got the same issue. Because if you saw the 350 pages of briefs and arguments that go back and forth that are not disclosed in the public record between the designated party and the FSOC, you would see that those parties are arguing past each other. Because the party in the designation seat is saying, show me the empirical evidence, I'll show you the historical precedents, and here they are. And FSOC is saying, well, this could happen, right? So there could be a run on life insurance policies. Never happened, but there could be, i.e. Prudential gets designated. So with that, let me just go through a few points here. I'm not going to go through them in any great detail. But I do want to, so I think the starting place here is let's look at what the Fed has done already with respect to a SIFI. They have proposed in December a form of prudential regulation for GECC. And they've taken the statutory and regulatory predicates that they have to deal with, and they've laid them out, and they say, here's what we want to do with GECC. So as to leverage capital, capital planning, off-balance sheet, liquidity, they say they look like a large bank. We're going to treat them like a large bank holding company. Very easy, all right? Risk management, they basically say we're going to impose bank holding company standards of a comparable size to you. Same answer. Other risk factors they came up with, they said, interestingly enough, they said we need some protections on the board level. We need a more independent board. And we need some 23A and B restrictions between transactions with affiliates. Again, highly bank regulatory approach to the issue. And then with respect to all of the characteristics in the statute, nature, scope, size, scale, concentration, transactions with other significant non-banks, basically what they say, again, GECC has never been regulated for this, but we're going to treat them like a large bank, all right? So the first example we have from the Fed is it looks for its keys under the light, right? It knows bank regulation. It knows prudential bank regulation. So let's just treat them like a large bank. So we've talked all day. I won't go into this much. We've talked all day. A critical factor, however, for the Fed is going to be the differences between banks and asset managers. I mean, there's nothing in some respects that is similar. So to take a prudential bank regulatory template and throw it over an asset management firm is going to be very difficult, no matter which of these factors you look at. Point on this slide is pretty interesting, and Pete Stahl made it this morning, and I'll make it again. Since 1934, more than 4,000 banks have been involuntarily seized. all right? In the last 10, 15 years, more than 6,000 funds have disappeared, all mostly, almost entirely voluntarily. And look at the difference in terms of market disruption you have from the bank failures and those of the funds and asset management vehicles. Enormous difference, both in terms of impact and ripple effect. So let me get to this last slide here that I think is sort of the punchline. If you're the FSOC, it seems to me that notwithstanding the fact that the statute allows you to designate simply based on a threat, it's a very interesting standard, and it's going to be litigated in MetLife. The standard is the threat, right? It doesn't require the FSOC to determine that that threat will in any way be mitigated. Unfortunately, the statute doesn't require that. Now, one would argue as a matter of rationality and logic, that's what FSOC has to do, because why would you designate them to be regulated by the Federal Reserve Board unless that's going to reduce the risk? So that's a fundamental predicate here and a fundamental issue that is going to be litigated in the MetLife challenge. But if you look at all the factors that the Fed has taken and laid out now in the GECC proposed prudential regulations template, and you apply it to asset managers and the asset management industry, and ask yourself, are these things that the SEC is doing, thinking about, or is already done? If you can see all of them, and I think Chair White's speech of December 11th, 2014 is incredibly important in terms of preempting some of this area and laying out some markers here. But if you take that speech and you take all the statute and you take the SEC regulations, what you come to the conclusion is that all of the things the Fed would do are either already done or being considered in terms of how they might apply and how they might best be applied. So if you come back to the FSOC, then the question has got to be, can FSOC do a better job of reducing risk, which has to be the issue? And the Fed, can they do a better job than the SEC? And, maybe you can come to the conclusion that the FSOC and the Fed knows better than the SEC, but I wonder if that's not emblematic of an arbitrary and capricious determination. I would point out, however, in each of the designations that have occurred with insurance companies, the sole voting person on the FSOC who knew anything about insurance, who was a former commissioner, a former CEO of an insurance company, and a former lawyer practicing in the business, voted no both times, no for designation. Anybody who didn't know anything about insurance voted yes. So I don't know if that's a good precedent here, but I'll leave you with that in terms of sort of some of the issues and the dynamics that lay out in this process relative to the application of prudential requirements and how, looking backwards, we might establish a record that says it's already done. We don't need FSOC designation.
Okay, thank you. Peter?
Okay, I don't have to push a button here, do I? I'd like to associate myself, if I can, with what Dan said in his remarks, because it does occur to me that the Dodd-Frank Act is a massive overreaction to a problem that arose from a very unique set of circumstances, and this is what Dan was talking about, and that is the occurrence of a crisis in the mortgage industry as a result of government housing policies. And instead, it has been generalized into a crisis for the entire financial industry, as though there is some inherent instability in the financial industry. And I would just suggest this, and that is, we haven't had anything like this crisis in 100 years. And so that means that this industry, the financial industry as a whole, leaving out more mutual funds or anyone else, the financial industry as a whole has functioned satisfactorily for 100 years without a crisis. And now we believe that there is something inherent in the way the industry is structured or what it does or how it conducts its business that suggests that we have to control it in some way that we haven't before. Now, I'd suggest to you, as I think Dan did too, that there is an incentive on the part of regulators to do exactly that, especially bank regulators. And I want to look at this, I want you to look at the chart that I've put up here, because actually, as a lawyer, I might say, if the question is, what's the result of prudential regulation on asset managers, I think this is the way I'd rest the prosecution. What we see here is that asset managers, as a part of the financial industry, I'd call it the capital markets industry as a whole, have been growing much more quickly than the banking industry. In fact, you might put it, they have outcompeted the banking industry over time. And they will continue to do so because they are not prudentially regulated. So when I was asked the question, what would prudential regulation mean for the asset management industry, that's the first thought that occurred to me. They will look like the banking industry looks now if we put them under the Fed's regulation or any other kind of prudential regulation, because prudential regulation has that effect. Now, I want to mention one other thing, and that is that because Paul Tucker, Sir Paul, said something that I thought is worth talking about. And that is, he mentioned that, if Dan is wrong, imagine all the terrible things that might happen. And so it's worth taking his advice and regulating, because if he's wrong, something awful can happen. Of course, that goes back to this question of whether the industry itself is unstable. But I would say this: only the government can create a real crisis in the financial industry, as it did in 2008 as a result of housing policy. And this, it seems to me, and also Tom and I discussed this before, we've only had one other instance where an entire industry has collapsed. It's called the S&Ls, the thrift industry, under government regulation as a result of government regulation. So the answer to Paul Tucker is, as I see it, what do we do if he succeeds and that regulation produces the crisis that we're all afraid of? And I think, again, if you look at this chart, you can see that that's a distinct possibility. Now, I think the chart is a cautionary tale for what prudential regulation would do to asset managers. But I have to mention that there is one factor that excuses to some extent what is happening here, and that is that basically the capital markets are much more efficient than banks in producing loans and credit for business. Once it became clear I would put the numbers a little bit further south there. I would say that in 1985 it became clear that it was possible to disseminate, because of technological changes, a great deal of information about business entities. And when that information became freely available, the banks lost the advantage that they had as the repositories of a great deal of business information. So their value to the economy began to decline at that point. But after that, and I won't go into that in any detail, after that it was basically regulation that was the main problem. And here is the chart that Dan Gallagher mentioned. This is the one he prepared. These are the things that have gone into effect covering U.S. financial holding companies, financial services holding companies, since 2010. This doesn't even include what they were subject to before 2010. These came out of the Dodd-Frank Act. Now, you can see what would happen. I won't say all of it would happen, but certainly a lot of it will happen to the asset management industry if they are then subjected to what this is, which is prudential regulation. Now, I want to summarize, if I can, what has been done to banks, because you can then understand a little bit more about what would happen to asset managers and the financial industry in general if prudential regulation were placed on asset management business. Added regulatory costs, I think you can see right there. Banks have also been prevented from entering related fields in which they were qualified because of their financial expertise and could have operated profitably. Banks have been prevented from entering, from buying assets or participating in activities that would have added substantial diversification to their assets. And in fact, we are now beginning to see in the regulation of banks the kind of credit allocation that will happen to asset managers when they become subject to prudential regulation, because it is not difficult to imagine the Fed saying, in part, we want to protect the economy against risk by managing these, by regulating these asset managers, and one of the things we're going to prevent asset managers from doing is engaging in risky activities like buying risky assets of various kinds, in the judgment of the Fed's regulators, rather than in the judgment of the market or people who are, in fact, in the business of making those kinds of determinations. Banks have been prevented from affiliating with other sources of capital and innovation. This is the so-called idea of separating banking and commerce. The effect of that has been to cause banks to remain outside the rest of the economy without the kind of new innovations that new management and new ideas would bring to the banking business if people who were in the commercial business of some kind were able to acquire and control banks. That's been stopped. They have also borrowing costs have been raised for banks. That is, because of regulation, the costs of borrowing from banks, in addition to being simply inefficient, have been raised because, this has made it much more difficult for firms that do not have access to the capital markets to have reduced cost of credit. When banks are made more inefficient, that means only the firms that have access to the capital markets are able to get access to that very efficient way of attracting capital and credit. That means that banks, as less inefficient, for the companies that banks are financing, and that tends to be mostly companies in the business of real estate, either residential or commercial real estate, are having to pay more than they normally would because the banks have so many other costs that they are having to pass on. So, what do we see? This is an example of exactly that. You can see that real estate loans, as a percentage of total loans, are very high in relation to commercial and industrial loans. There's a reason for that. Most of the people who are who would be borrowing on the commercial or industrial level have access to the capital markets. They are able to issue bonds, notes, commercial paper, and borrow much more cheaply than going to banks. This is an example of what will happen, I think, to the asset management business if it is put into that kind of situation. Now, why are all these restrictions placed on banks? In part because they are regulated. Now, of course, they have to be regulated to some degree because of moral hazard. Their deposits are insured, and as a result, people are less concerned about the kinds of risks that they are taking. One minute. So they must then be regulated in some way. We're talking here about a question of overregulation. And why does that occur? It occurs in part because regulators are afraid of the criticism that would come in the event of losses. So they tend to place many more regulations on financial institutions like banks than they would, and they would do the same if they were in a position to regulate asset managers and other non-prudentially regulated institutions today. That's, I think, a summary of where the asset management industry would be if prudential regulation were ever placed on their activities. And it is a danger because it would reduce the growth in the U.S. economy, because credit would become much more expensive for all businesses, not just those that have to borrow from banks, and the industry itself, asset management and securities activities in general, would be substantially reduced and made more expensive. Thank you.
Okay, thank you. Marcus?
Okay, is there a button? No, there is no button. Well, I would say Peter mentioned that he seemed surprised at the idea that there might be some inherent instability in the financial industry. I think you can look back at several centuries of evidence that there is, in fact, inherent instability in the financial industry. And in fact, I wouldn't trust you to be my asset manager unless you understood very well that there's inherent instability in the financial industry, because that inherent instability is a major threat to my investments. And if you want to see examples of that inherent instability that far predate government regulation, you can go back to 1929, you can go back to 1907, and you can go back like clockwork every 15 or 20 years to various other financial panics and crashes, going back to the South Seas bubble and perhaps the Dutch tulip mania before that. So I think we've got plenty of evidence of that. And you can also, by the way, look to extensive experimental evidence, probably hundreds of papers at this point, that's been produced by economists, that asset markets, perfectly competitive asset markets, where the value, even where the long-run value of assets are transparent to the participants in those markets, when those markets are set up experimentally, they generate bubbles and crashes just as part of the dynamics of trying to anticipate what asset values are going to be. So I think that we certainly do have evidence of that. And we also, frankly, have evidence that asset managers, as you would expect, because asset managers are major participants in financial markets, who are, as someone said earlier, the conduits and sort of organizers of investor sentiment in these markets, play a major role in these incidents of financial instability. I think the last pure banking crisis we had was the S&L thrift crisis that Peter referred to. But if you look at the crises that have occurred since the 1980s, or in the 1980s even, the 1987 crash, that was in major part driven by program trading, hedge mechanisms that were used by asset managers. The Asian contagion in 1998, which actually looks on an international emerging market level, has a lot of the same characteristics of the global financial crisis, except it was more constrained. But if you were in Asia at that time, you saw a very, very severe financial crisis with an enormous impact on the real economy. That was asset manager driven in many ways. Long-term capital management was a hedge fund, a form of asset manager. And the global financial crisis of 2008, I think there's a significant role for asset managers. For certainly the money market fund aspect of the asset management industry, I think there's widespread consensus on that. And I should have known when Peter's name was on the panel here that there would be a relitigation of whether the GSEs caused the global financial crisis, and I don't want to turn this panel into that kind of relitigation, which it could easily become. But the striking thing when you look at the mortgage and housing markets in the years leading up to the crisis is the massive growth in private label securitization, from a 10% share of the market to a 40% share of the market in the years before the crisis. And in fact, the PLS, and I'm sure AEI has set its people to work trying to show that this somehow didn't occur. But if you look at the history of the mortgage markets over the last century, the striking periods where we see the striking thing about that period is the growth of private label securitization. It's not the existence of the GSEs, which have existed since the 1930s. And in the private label securitization market, we see significant involvement, of course, of funds that purchase these private label securitizations unwisely. And I'm not saying that that's necessarily, I mean there were a lot of contributors to this false confidence in private label securitizations. But we can also see how the impact of the crash in the private label securitization market was mediated through the financial markets and through asset managers. There's been a very important recent piece of work. People talk about that these impacts of asset management on financial stability or the real economy are somehow hypothetical. I think that's a misstatement of it. The next crisis, what one might hypothesize to be the next crisis, is hypothetical because it hasn't happened yet. And if you knew what it was, you should leave the government and leave panels like this and go make a lot of money investing on the basis of knowing what it is. So the next crisis is hypothetical, but the realities of the past crises are not hypothetical, and the role of asset managers in those crises are not hypothetical. This work I'm talking about is recent work by Aslan and Kumar, and what they basically find is that insurance companies and asset managers that were heavily invested in subprime securities were forced to engage in fire sales of their corporate bonds as a result of trying to raise money and to meet redemptions when they had, well, a variety of reasons, including, to be fair, some regulatory reasons on the insurance companies. But as mortgage-backed securities lost value, these companies were forced into fire sales of their corporate bonds, and the corporations whose bonds those were had very significant drops in investment and in profit over the next 2 years. So right there you see what is essentially a run on one market, subprime mortgage-backed securities, where you have a contagion mechanism of fire sales that's mediated through asset management and insurance companies and the dealer banks, that then impacts the real economy in some very significant ways. And that's a very fine paper. It's very well documented. The source of variation is exogenous. It's very well done. So I think the way to understand what's actually going on in the regulatory community right now is not a desire of prudential regulators to extend banking regulation to asset managers. I think it's exactly what Mr. Vartanian said to start it off, is sort of a realization that, hey, the economy has changed and there's a lot more financial market mediated credit. Asset managers are key players there. And as systemic risk regulators, we need to be concerned with the way the financial system really does mediate credit, which is increasingly market mediated at this point. And if you look at I think the drivers of trying to take a closer look at asset management, the Federal Reserve and the FSOC, these are not best understood as prudential regulators. They're best understood as the systemic risk regulators. I mean, to the extent that we have a single buck stops here systemic risk regulator in the U.S., it's some combination of the Fed and the FSOC, because the Fed is the backstop lender of last resort, right? So they're the people who are left holding the bag when there's going to be large-scale lending to the financial system. And the thing that keeps them up at night, I think, is a liquidity crisis in the broader markets. And I think that the drive to look more closely at asset managers is about saying, well, under what conditions could we see redemption demands or some form of quote-unquote failure of an asset manager driving a liquidity failure in the broader traded markets. I had a regulator say to me, a prudential regulator actually say to me that, well, let me start by saying I think there are a lot of ways to skin that cat about thinking about systemic risk regulation of liquidity crises in the broader financial market.
You've got one minute
right.
to skin it, just so you know.
Yep, thank you. It's not a simple problem. But I think that one could handle it through the right kind of cooperation between the prudential regulators and the FSOC. You can handle it through joint activities regulation. I think the question of designation of individual entities has some problems as a way to handle that, but I think there's internal conflicts, political conflicts within D.C. that I think Paul Tucker referred to that are driving some of the desire to do that. I'm just going to close with this. I was just talking to a prudential regulator about this, and he said the SEC as a market regulator can respond 3 different ways when we come to them saying that we've spotted an issue in the asset markets. They can say, we're looking at it, but we'd love to have your input on the best way to handle it as the entity that's the consolidated regulator of bank holding companies who are important players in these markets, as the systemic risk regulator. Or 2, they can say, that's an interesting thought. We hadn't thought of it, but we'd like to look into it and we'd like your help with it. Or 3, they can say, go away, it's none of your business, you don't have any jurisdiction here. And that third answer, I think, is extremely dangerous for regulation of the financial markets and the handling of systemic risk, because it just does not recognize the realities of how market risk works and how a lot of credit is intermediated today. So,
Okay, thank you, Marcus. Hester?
Thank you, Doug. Well, I think even if we accept what Marcus has postulated, that asset managers are a source of great instability and have historically been, I would argue that, and this goes to something that Peter said, it's not necessarily clear that our answer should come from government regulation. And I guess in response to Sir Paul Tucker, I have this chart which shows the Fed's regulatory power, which has been increased since Dodd-Frank. And I will tell you that from personal experience, I was on the Hill at the time Dodd-Frank was put in place, and the Fed folks were remarkably effective lobbyists, and they managed to increase their power tremendously. And by having sort of these nebulous mandates, such as financial stability, they're able to expand their jurisdiction even further. And I don't attribute bad motives to them. I think it's really more their belief that they do a better job at regulating than anyone else. I think some other people might take issue with that, given what happened during the crisis. But I do think that that's genuinely a heartfelt belief that they have. So I'm glad to be on this panel talking about what prudential regulation would be, instead of talking about whether or not there will be designations of asset managers or asset management activities, because I think that it's sort of a foregone conclusion. There's this desire in the minds of the Fed, the FSB, and FSOC to pull in asset management activities in some form or fashion. And so no matter what answer you give to argue that there's not a systemic risk or that the market can handle it, they can come back and say, well, even if there's not one firm that's a systemic risk, we're going to look across at aggregated decisions. And so if you aggregate everyone, wow, is this a large industry? So we've got to do something about it. So I think it will happen. Now, I think there are different approaches that could be taken. And one is there could be designations of large asset managers. And a second possibility is the recommendation route, which is what FSOC used with respect to money market funds, to basically tell the SEC what it needed to do. And I think that that's a very likely route for them to take. It puts the SEC in a very difficult position when they have another government agency telling them you're not regulating right, and here's what we suggest that you do. And so I think we could see things like leverage limits, liquidity requirements, concentration limits, risk management requirements, stress testing, capital buffers, and reporting requirements. And some of these are things that Chair White mentioned in her speech in December, and so it's not surprising that some of these things would be potentially thought about. But the concern is that coming from a regulatory body like the FSOC, there are going to be unique issues because they don't think about regulation the way the SEC thinks about it. And the SEC understands that asset managers have a fiduciary duty to the people whose money they're managing. And so that fiduciary duty figures into what they can and cannot do. And the notion that's behind financial stability is that you can have rational actors making rational decisions in the best interest of their investors, but we just don't think that those are good for the collective public. And what that means is that they'll suggest to the SEC, or directly if asset managers are designated, they'll force asset managers to do things that are counter to the interest of their funds or their investors, which I think is incredibly problematic. And so I think it'll undermine the SEC's existing missions. And I think also, I hate to mention the Administrative Procedure Act for the second time in one panel, but I have to say it because I'm a regulatory lawyer. It's very difficult for me to conceive how the SEC can comply with its mandate to follow the Administrative Procedure Act and to conduct economic analysis if it's being told what to do by an outside entity, which could be the FSOC or, the FSB. It's even worse when it's coming from the FSB through the FSOC and back to the SEC. And then I think it also changes the asset management industry. The types of rules we'll see will change it in terms of what we've talked about on this panel and other panels have talked about, the idea that failure can't happen. Failure is such a critical part of what goes on in the asset management industry. Particular investments don't succeed, and particular investment companies don't succeed, and that's okay, and it has to be okay, because otherwise you end up having a government-backed industry, which is exactly what we've seen be so problematic in banking. And one thing I would say about the private label securities point that Marcus made, one of the major drivers of that was bank capital rules, Basel rules, which drove banks to, of course, try to hold the highly rated securities that qualified as being low capital requirement securities. And I worry about similar types of rules being imposed in the asset management industry. And then the final point I'll make is that I worry tremendously about the distraction. We've seen in the banking world thousands and thousands of people being deployed to deal with stress testing and other responses to regulators. And we're seeing now in the asset management industry that people are spending a lot of time trying to game out how to respond to this systemic designation possibility. And I, as an investor, wonder what would that time otherwise be devoted to? Frankly, I'd rather have them spending a little more time to make sure that they're hacker-proof than that they're spending time to worry about pleasing the regulators. And it's easy to dismiss that point, but it's I think, a tremendously important point, and I think we're seeing high-level attention being devoted to issues that are not getting us anywhere in terms of individual good or collective good. So I'll end with that.
Okay, thank you all. I thought there was very good remarks by all of you, and Hester gets extra points for being someone who actually finished early. You have no future in the think tank world, I have to tell you. But I'm sure that won't break your heart. I'm going to be a little bit less than normal moderator neutral just because Marcus is a little outnumbered here, I think. So forgive me if I play Marcus advocate or whatever it is I'm doing here. But let me just give you a few reactions I had listening to each of them. I largely agree on the point. We'd have been better off if Congress had chosen to set it up so first we figured out what would happen to a SIFI, and then we figured out how to decide who was a SIFI. But I think we do have to recognize Congress made a conscious choice. They said, given that the world just blew up, go figure out who's important, and then figure out how to regulate them. This is not a crazy concept. It's just not, I think, the best concept, since in reality we've had the time to do it the preferable way. Tom, I think you should go back and check the statement you made. The idea there's never been a run on life policies, I believe, is factually incorrect. Mutual benefit life, executive life, we've seen life insurance companies in the U.S. of major size. Mutual benefit life was 10th largest in the U.S. We've seen them die of runs. And I'm confident that life policies were part of what was run on.
Yeah, no, I think the point, and you're right, the point I was trying to make is that they are not endemic like bank failures, and that they don't happen that often. And so relying on them as a basis for designation seems to me to be taking the smallest amount of evidence you can conjure up and laying that out as some predicate for designation.
I guess I'd give it more significance to that, but I do take your point. Perhaps if I'd let you have 11 minutes instead of 10, you would have had the chance. Peter and I have had this discussion a million times, but I just have to say, even if we fully accept the idea that this was the mother of all housing crises and that's really what this was about, I've never understood why we shouldn't then fix all the problems that were revealed by the crisis. My analogy is the San Francisco earthquake of the early 1900s. We had massive fire damage. I don't think the right answer was to say, don't worry about the fire codes because that was caused by an earthquake. Marcus, I'm interested in your point that you believe asset managers have been historically organizers of financial sentiment. It might be worth coming back to that and expanding on it a little bit, because I do think one of the fundamental issues that we don't know the answer to at this point analytically is to what extent are the things the asset managers do because of their end investors, and to what extent are they endogenous to the asset managers themselves, and it's some mix. It's one reason I personally tend to be skeptical that any of the asset managers in the U.S. currently deserve designation. I think most of the risks would exist even if they didn't. But that's not, I think, at this point provable, but we really need to collectively be clear about our beliefs on that, and I think you may differ with me on your underlying beliefs there. I'd expand on one of Hester's points. I don't think it's just that the Fed believes that they are the best of all possible regulators. I think it's also they specifically don't trust the SEC. They don't believe that the SEC has a culture and a capability at this point in time to deal with prudential risk. And it's not something they would say out loud, but I think you can just see that it colors their beliefs. So,
Can I just respond to that?
yeah.
I think the Fed has a very dangerous culture itself, which is one that tolerates no dissent, and that is incredibly dangerous, especially when we're dealing with issues like this, because we are, and they'll even admit, we're in new territory, and so for an organization that refuses to hear from internal or external dissenters to criticize the culture of another agency that's clearly open to dissent is, I think, kind of humorous.
Yeah, and another spin I would put on that is comments I've heard from the FSOC staff that I think I would equate to their questioning whether market regulation has any future and whether everything should be prudentially regulated. And I think you can explain that as a difference between their view of the SEC and their view of the Fed, that they would prefer to see everything moving towards prudential regulation, obviously, which is a Fed culture.
I don't see that. I mean, and I see the desire is not to wipe out market regulation in favor of prudential regulation, but to bring together prudential and market regulation and broader systemic risk regulation. And that's exactly what Paul Tucker was saying, that this is about systemic risk regulation. It's not about these two poles of market and prudential regulation, which I think during the crisis were both revealed as too narrow because of the interpenetration of key institutions and markets. I mean, our major banks are now the dealers and intermediaries in the markets. So it's just very hard to understand the risks that the banks are taking, or the risks that are being posed to the banks, without understanding the markets they operate in.
Okay, and by the way, just to be very clear, I'm not endorsing or criticizing the Fed's view of the SEC, but when we think about their motivations, I think it's important to understand they just don't trust the SEC on these issues. Peter wanted a chance to respond to my slam of him, so I think it's only fair.
I don't think it was a slam necessarily, but I do want to point out that fire codes coming from an earthquake are a lot different from a comprehensive set of regulations coming from an action that was in fact human-caused. And we ought to understand, of course, we can't do much about earthquakes, but we can do a lot about the things that cause a financial crisis that were caused actually by human activity. The real question here, and that's the one I started with, is the financial system inherently unstable? Or was it made unstable by actions of the government? And if we look at the history of things, of course there have been cases where large companies have failed. There have been cases where whole areas of companies have failed in Europe or in Asia, and that has had an impact in the United States market. But the question is is any of that systemic in the sense that we have to rely now on government regulation to protect us from the adverse consequences of those things? And they've happened now over the 100-year period since the panic of 1907, which is basically the last time we had anything like what happened in 2008. The Depression was not that. That was actually started in the real economy and then spread to the banking industry. But what happened in 1907 was a collapse of the financial institutions. That was the last time it happened. And so the question we have to put before people is, do we need an entire new set of regulations on the entire set of economic factors with the consequences that will have for economic growth, when we have very little evidence that the economy as a whole is unstable without the government's intervention? And I would mention one other thing just as a fact here having to do with what Marcus said. The private securitization system, yes, it got as high as 40%, but Fannie Mae and Freddie Mac, the government, representing the government, were the major buyers by far of those securities, which were created for the purpose of helping Fannie Mae and Freddie Mac meet the affordable housing requirements. So those pools that were created were made up of mortgages that met the affordable housing requirements. And I would say one more piece of data that is in my book that I think is significant, and that is that in 2007, more than a majority of mortgages in the United States were subprime or otherwise low-quality mortgages. Of those, that was 31 million mortgages. Of those, 76% were on the books of government agencies, principally Fannie and Freddie. So if you want to make up some sort of calculus about who was responsible for the financial crisis, you would at least look at the policies that caused 76% of all the low-quality mortgages to be on the government's books, rather than looking at the private sector.
Yeah,
So AI
Marcus,
came up with their own, I mean, you know.
No, it's okay. As you pointed out, this could be another whole different discussion. I suggest you read Peter's book.
Good, I like that.
I tend to mostly disagree with it, I have to say, but it is definitely
As
worth
well
reading.
as the 10 different sources that disagree with Peter's book.
But-
A very good reason to read my book.
Exactly. Yeah, turns out there are a lot of reasons to read his book. I've also got one too. It's sold literally hundreds of copies. So if you guys want to do it, it's on the federal credit programs, and yeah, you'll be one of the first people in your neighborhood to have the book. But no, the reason I wanted to interrupt is because what I'd like to do as a last set of questions before we go to the audience. So I'd like to just go down the list here, and if you tell me, do you think there should be any prudential regulation of asset managers? If you do, could you just give at least a couple examples? If you don't, how do you think we can best minimize the damage from the fact that there may well be such prudential regulation? So, Tom?
Well, I guess I'd answer those questions this way. That if I would not apply the prudential regulation that we have today in place that we would anticipate from the Fed, or at least believe the Fed would apply to asset management.
If I could slightly more general, is there any prudential regulation you would like to see for the asset managers?
No, because I don't.
That's fine.
Because I don't think there's that the historical precedents or the empirical evidence substantiates the kind of problem that would require prudential regulation. And look, I mean, I think I would also point out, and Peter said this in a different way, I mean, never underestimate the ability of regulation to get it wrong, and never underestimate the ability of regulators to get it wrong, because regulation, and I believe what Peter said is correct, and I think I can prove it from historical facts, and that is regulation can cause as much financial crisis as the market can. And in fact, many of the crises we've got have been caused by misguided regulation. So I start with the assumption that prudential regulation for an industry that doesn't relate to it, it could probably do more harm than good.
Okay, Peter?
My answer is no, of course, because I think the market is better at judging risk than regulators are.
And do you see any straightforward way to minimize the damage that will occur if we do get some prudential regulation of asset managers?
No, I think it's going to be very difficult to do that. You'd have to withdraw a regulation, which doesn't occur.
Okay, Marcus?
I think that prudential regulation of assets, it's somewhat, I see it as setting up a false dichotomy. I think, there shouldn't be regulation designed for banks put on entities that are very different from banks. But I do think that there should be regulation that addresses some of the same kinds of risks of prudential regulation put on funds. And we have a very good example of that in the 1934 Act, which places all kinds of liquidity and leverage restrictions on mutual funds. And that is liquidity, leverage. These are the same things addressed by prudential regulation. And I think there should be regulation of that. And I think we have a long experience of that regulation working well. But I think, and this is part of the issue of mistrusting the SEC, I think over the period since the 1980s, the SEC has permitted that regulation to be undermined in many, many ways, involving the use of derivatives, involving the use of alternative investments, involving the liquidity rules and so on. And I think that the Fed and the SEC working together to strengthen the stuff that funds already should be doing for investor protection to manage liquidity risk and the risk of their liabilities would go a long way and be very helpful.
But just to make sure I understand, it sounds like what you're saying is using primarily the powers of the 34 Act and maybe expanding them a little bit, dealing on a firm-by-firm basis with things like liquidity requirements would, in your view, be sufficient, or do you see something of more of a macroprudential nature that would be necessary?
I think that in things like stress testing, and I actually view disclosure and transparency, which there's huge problems with the gaps in transparency and disclosure that have opened up around the exemptions from the 1930s Act. I see those as having a macro-prudential component. So I think there is a macro-prudential component. This is very long. This is a whole other panel, right?
Yeah, probably. Hester?
No, I don't see the need for prudential regulation. I think what you could do to counter the effects of imprudent prudential regulation would be to see if you could, one, I think transparency is a fair point. I mean, we need to make sure that investors know what they're investing in. So what, can we improve transparency? That would help. And also just make it more possible for, I guess, get rid of some other regulations, so at least there'll be less distraction.
Okay, fair enough. Let's give the audience a chance. We've got about 10 minutes. Again, please wait for the microphone, identify yourself and your affiliation, if you could, please.
Hi, I'm Mike Granito from Federated.
Okay, sorry. Good.
We've talked about whether or not the investment management industry should be subject to prudential regulation, but investment advisors already must be fiduciaries with respect to the assets they manage. That's not a requirement in the banking world. And then I think maybe in part responsible for why you haven't seen the same kind of, malfeasance in the investment management that you routinely see in the banking side. So isn't it in fact the case that the investment industry is already subject to prudential regulation through the requirement that they serve as fiduciaries?
I'll let the others answer, but I think the way most people mean prudential regulation, they're actually not talking about the same thing as you're talking about.
I actually wanted, this was kind of what I was getting at, my response to the last question, that a large amount of what we spend, what Americans for Financial Reform spends its time fighting for in D.C. is let's take these concepts that were in the 1930s Act, like fiduciary responsibility, like the leverage and liquidity limits that were placed on funds in the 1930s, and let's really make them real, and let's re-examine whether changes in the financial sector over the last couple decades have undermined them and have undermined their effective enforcement.
And I think the regulatory road we're going down certainly will undermine fiduciary duty because it will be impossible to please both your regulators and your investors.
Can I say something about that, actually? 'Cause that's
Briefly, please.
Yeah, I think that it's well established in economics that individually rational decisions can lead to bad collective outcomes, and that can mean that there can be an advantage for a group getting together and trying to ensure that the group takes a decision that's for the benefit of everybody, and that actually can legitimately conflict with the interests of an individual, even an individual investor. And if you take the example of a bank run, if there's no coordination at all, it can be to the advantage of every individual investor to run for that door and try to be the first. But not everybody's going to be the first, and that bank may collapse. But if people can coordinate around the decision that we're not going to run for the doors, we're going to stick through it, then everybody does better. So there actually is a fundamental conflict. There can be, in certain cases, a fundamental conflict between the individual and the collective interest, where it can be to the advantage of investors if people can coordinate around a collectively responsible response.
I do think that there's room for coordination, but I think it's better done on a private level, and so it's not necessary for the government to be that coordinator. And in fact, I think that the government, despite all its desires to collect a lot of data and analyze it, will be incompetent at that task, and so that's better handled in the private sector.
Okay, we've got a question over there.
Yes, hello. Most of the discussion today.
Sorry, if you could say who you are and who
Yeah.
you're with.
Peter Ferriel, and I'm with Ramon. Most of the discussion today has distinguished between banks on the one hand and asset managers on the other hand. And yet there is a subset within the industry of bank-affiliated asset managers where it may offer some insight on the worst of both worlds, where you have the Fed as a prudential regulator playing an oversight role today. You have the Volcker rule, and yet you also have institutions that are SEC regulated. So I wonder if the panelists could comment on the extent to which bank-affiliated asset managers are a test case for where other asset managers may be heading.
Tom?
Yeah, well, that's a great question, because I know the Fed now is actively engaged in looking very closely at bank affiliates in the asset management world, trying to figure them out more assiduously perhaps than they did in the past. But I think at this point, the Fed is using them as a little bit of a test case to see where they should go. But I think that they haven't yet felt the true aspects of Federal Reserve Board prudential regulation, because that has normally been left to the SEC. And to go back to Mike's question, I think the answer is, given the different templates in the industries, I think the asset management world has the right form of prudential regulation, if you will, today. But I think this is an interesting question only because I know the Fed is in various affiliates of banks now, looking at them, trying to figure out what it means to regulate them a little more closely.
Yes, I think they have authority now under Dodd-Frank, or at least they feel they have authority under Dodd-Frank that they didn't have before under Gramm-Leach-Bliley. Even though they were sort of an umbrella regulator, it was still, they had to interfere with an acknowledged regulator in the form of the SEC in order to get down into what the asset manager subsidiary of a bank holding company might be doing. So I think they are flexing their muscles, and over time we will see, I think, a difference between how asset managers operating under a bank's supervision and under the Fed supervision function, as opposed to asset managers who are independent. And I expect that there will be a visible difference, but it's too early.
Okay. So a question back there.
Hi, thanks, Doug. Aaron Klein, Bipartisan Policy Center. I wanted to ask this distinguished panel to pick up on a topic discussed at lunch. Do each of you think the SEC should have a financial stability or systemic risk mandate?
Great question.
No.
Okay, there's one no.
Yes.
Peter?
It's
No, yes, no, no.
To me, it's completely inconsistent with the SEC's functioning, which is in most cases as an agency that is promoting disclosure. And this is the very difference, there's a great, tremendous conceptual difference between, as I see it, a prudential supervision and disclosure. Because disclosure is supposed to give the users of the service information about where they should and how they should function with respect to that service. And something like prudential supervision actually creates moral hazard, tells people nothing to worry about here because the good Fed is overlooking everything that you are doing, or your bank or your asset manager is doing, and so you don't have to worry about the risks they are taking because they are much more informed people. They're in there every day on your behalf. So I think it doesn't work.
Yeah, sorry, go ahead.
I would say no also, only because there is a distinct cultural divide between prudential regulation and disclosure. And I've seen situations where bank regulators didn't want somebody to disclose something. The SEC would say in a minute that you have to disclose that. So that cultural divide, I don't think, is easily bridged.
Can I say one thing?
Actually, if I wanted to ask a follow-up question, but for those of you who don't think the SEC should be doing this, you seem to be the exact same people who also don't think anyone else should be doing it. It seems to me that each of you believes that there shouldn't be prudential regulation of the asset management industry. My question would be, I would think the hardest case for you would be, what if we did see a lot of what is being described as shadow banking? That you had a number of firms set up who really act like banks except with market funding and become core to the financial system, particularly since the regulatory burdens on the banks have gone up so much. So really just an extension of your chart, Peter, where there's such a big gap that almost everything we care about in the financial industry is now being done there, which is a big chunk of credit intermediation. Do you think the ones who are really acting like banks need to be pulled out and regulated differently? Do you think if they're doing it through the market, you just don't need prudential regulation? What would be your argument?
If you're acting like a bank, you are engaged in maturity transformation.
Okay.
That is the essence of banking. That is risky. And I don't understand how an asset manager can be engaged in maturity transformation.
So where do you come out on money markets then? Where do you come out on money markets? I've never talked to you about this. Money market funds.
Well, money market funds are short-term investors in short-term assets. That isn't, as I would see it, maturity transformation. Maturity transformation is using short-term liabilities for the purpose of making long-term investments of some kind. And that's what is risky about banking. That's why banking, aside from being insured, that's why one of the reasons banks are regulated, because they are engaged in that business. But I can't understand how asset managers could be said to be engaged in maturity transformation.
Marcus, do you have any thoughts?
I mean, I think that asset managers can benefit by creating what one might call a liquidity illusion, by promising people that liquidity will be readily available on assets that are in fact illiquid, more long-term, and difficult to sell. I think that is a form of maturity transformation that the regulators are worried about. I think that money market funds, although nominally the paper they held was short-term in the sense that it turned over, it was in fact funding much longer-term assets. And just in terms of, well, anyway, I'll let you continue. But on the systemic risk mandate for the SEC, I actually think that disclosure can be an incredibly powerful way of addressing systemic risk, because I don't think systemic risk can or should be managed by permitting a bubble to inflate and then just allowing people to run for the exits at the end, or being afraid of people running for the exits after a bubble has inflated and therefore sustaining the bubble through government support. I think these are very unhealthy things, and I actually think it's correct that the prudential regulatory model, which sometimes emphasizes regulatory sort of deferral of action, regulatory forbearance, has some very unhealthy elements to it. And I think that healthy systemic risk regulation provides disclosure early and often, which allows normal market fluctuations instead of the inflation of large bubbles that are totally unconnected to real underlying value. And I
Let
think
me,
that the
let me
SEC
stop
could
you
do
there,
that.
just because we got one final minute. I wanted to give Peter a chance, since I put him on a spot, to finish up his
Well,
thought.
I think what Marcus talked about was an illusion of safety or something like that. Now, the whole point of disclosure is to make sure that these illusions are overcome. That's the whole purpose of what the SEC is supposed to be doing. I'd also mention that the FSB has been talking about shadow banking in a way that probably most of you have not noticed, but they call it,
Actually, I think almost all of them have noticed, but please.
maybe, they call it, they call it a complex chain of transactions, which involve many players at the same time. So they're not talking so much about individual entities, but they are talking about transactions in which many small entities, or at least non-systemic kinds of entities, participate. And they want to regulate that as systemically risky, even as maturity transformation in some sense. And so that's what we're talking about, or we should be talking about, when we're talking about shadow banks being regulated.
Now you tell me it's the end of the panel, and now you tell me what we should be talking about? Okay, well, thank you all very much. Appreciate that.